If you're interested in property investment or buying a new home, this week's Property Insider Chat with Dr. Andrew Wilson is just for you, because we talk about rental affordability, and that's very different to housing affordability. We have a look at how US inflation, which is at 40-year highs, is going to affect us back home. We're going to have a look at what the Reserve Bank thinks rising interest rates are going to do to Australian household budgets, and we'll get a sense of what's happening in the market with the latest auction results. If you want to keep up to date with what's happening in our property markets, please subscribe to this YouTube channel and click the little bell icon so we can let you know each time a new show comes out. We know that housing affordability is a real issue with many Aussies who are now finding it harder to buy their home. But what about rental affordability? With more and more people looking to rent for longer periods of time, at a time when the number of available properties for lease is very low and vacancy rates are high and rents have gone up considerably, what does this do to rental affordability, and how will this affect rental increases moving forward? That's what I want to discuss in this week's Property Insider Chat with Dr. Andrew Wilson. I also want to get his views on US inflation, which has hit a 40-year high, and we're also going to talk about the Reserve Bank's recent financial stability report, which contains some modelling that shows most Aussie households could service their loans even if cash rates went up to 3.6%. Lots to discuss today. So, hi Andrew.
Yes, good day, Michael, and another interesting week, particularly which we will discuss later in the auction markets, which are still rising. Certainly been what could we call it, a traditional spring selling season so far?
That's nice to know, isn't it? I know my housing market closely monitors the rental markets around Australia in the capital cities, and you recently released your statistics for the month of September. Yes. What did you find?
Well, the trend continues, Michael, and I think you mentioned affordability, rental affordability. And I think we're seeing clear signs of the impact in terms of the shift from house rentals to unit rentals. Of course, unit rentals are typically more affordable. Again, over the month of September, we saw house rentals flat. In fact, all capitals, with the exception of Canberra, recorded either a steady house rentals over the month or higher in the case of Darwin. But I think that, again, reflects the shift away from house rentals because of the high level of house rentals into more affordable unit rentals. And, of course, supporting that particular argument is that rentals in units continue to rise, particularly in Brisbane, Melbourne and Sydney, which, of course, are the big rental markets for units. And I think that just is really reflecting the difficulty that tenants are having in not just securing a house, but being able to afford to secure a house for rent in the big capitals.
Well, it's a bit different from COVID, where people were wanting more space and prepared to move out. I think we've now moved back to a more normal lifestyle, and people are prepared to trade space for place. So they want to be in those good locations, those good neighbourhoods, be close to their friends and family. And if they can't afford a house, they're buying apartments. And if they can't afford to rent a house, Andrew, they're renting apartments.
The purchase market for units is still quite reasonable, Michael. In fact, in some of the smaller capitals, Brisbane, Adelaide and Perth, we're still seeing quite significant price increases for units. And I think that's a part of the affordability shift, and also the lifestyle preferences for a more inner city connection and, as you suggested, stronger levels of infrastructure. But I also think on the demand side, we may be seeing signs again that rents are being lifted by the opening of borders, with migrants coming in, and particularly international students fertilising those inner city unit markets, particularly Sydney and Melbourne, and particularly Melbourne. And even though when we look at the vacancy rates, Melbourne still stands out as having the highest vacancy rates for both houses and units, and unit vacancy rates are still above 2% in Melbourne, but by gee, they're falling sharply month by month. And once, of course, we move under 2%, we're really seeing a tight rental market. And I think we're certainly headed for that in Melbourne. Speaking of affordability, Michael, and high rents, and certainly high rents are an incentive for first home buyers to get back in the market. I thought it was interesting with the latest home loan data, Michael. We not surprisingly saw another fall over the month of August in home lending. Didn't fall by as much as the previous month, and just a sign that that's actually settling too, home lending. But what I thought was very instructive, and in terms of affordability, was we actually saw an increase, right, not a decrease, but an increase in first home buyer activity over August. It went against the trend. Owner-occupiers fell and also investors fell. And of course, that's all about higher interest rates and the end of the boom cycle in home lending. But I thought it was really interesting that actually first home buyer numbers moved upwards over the month against the trend. And I think this does reflect, A, the disincentive for renting first home buyers have, B, the extension of the first home buyer deposit scheme, which of course came into effect in July. Of course, prices are lower, Michael, and there's nothing a first home buyer likes more than lower prices. And I think this is part of what we're seeing in terms of strong growth in the unit markets at the moment in Melbourne, Sydney and Brisbane. So, yeah, looks like first home buyers are leading the charge back into the market.
It'll be interesting to see what happens early next year for New South Wales first home owners, Andrew, when they're going to have a choice of not paying stamp duty, having a little bit more money in their pocket to get in the market, and paying land tax over the long term.
Yeah, it will be, Michael. Yeah, big decisions to make there.
Now, in Australia, inflation remains in the news, but we also look at what's happening around the world because we don't live in isolation. And over the last week, US inflation soared to 40-year highs. It actually was increased by about twice the pace that were forecast by most economists. Well, how's that going to affect us here in Australia?
Well, it's certainly affecting our currency, Michael. In fact, it's affecting all currencies. The US dollar has gone through the roof because of the differential, particularly in interest rates in the US compared to other countries. Of course, US interest rates are higher, significantly higher than Australia, and set to go higher because of those latest inflation numbers that you mentioned. In fact, headline inflation in the US actually fell by 0.1% over September, and that was basically a reflection of lower fuel costs, pushed that inflation rate down marginally over September. That's headline inflation. But their underlying inflation rate, as you mentioned, Michael, soared to its highest levels in 40 years. And that, of course, is the measure because it takes out the volatile items such as food and oil from the measure. And that's the measure that the Federal Reserve is using as its benchmark. And that's causing some real concern. I think that they're starting to look like they really are getting into a wages prices spiral in the US. Of course, they have a significantly different wage setting system, as we've discussed here. Their wages respond very quickly to changes in prices, particularly, whereas we have a much more retarded effect with our wage setting mechanisms. We have annual wage reviews, sometimes 2 yearly wage reviews, and also wages are also set based on local productivity measures. So, and the enterprise bargaining. So US aren't like that. The UK aren't like that. And that's why they're having a bigger problem, I believe, in controlling inflation. But again, it just shows that good luck or good management that we're in a better position compared to the US. But the offset to all of this, Michael, is that very strong US dollar is pushing our dollar maybe under 60 cents US soon. We're certainly in the low 60s now. That's really good news for our exporters, notwithstanding the mechanisms that exporters do use to control differentials in currency. But certainly it should help our exporters by making our exports that are priced in US dollars more attractive. And of course, the offset to that is imports become less attractive and more expensive. But they would typically be exports from the US, although, as I said, there's some managed currencies that we import in US dollars as well. But nonetheless, it does show the outlook for the US is not great. Our dollar will continue to fall as the US sucks in capital from its higher interest rate position.
Now, Andrew, on a different tack, the semi-annual Reserve Bank Financial Stability Review came out a couple of weeks ago, and the Reserve Bank did some modelling to see how the average Australian household would cope if mortgage rates rose in line with market pricing. Now, we spoke only last week about the fact that there's still going to be a couple of increases in interest rates, but not as much as some of the market commentators were suggesting. But only around a third of Australian households have a mortgage. I guess that's because half who own a property don't even have a mortgage against it, and a third of Australians tend to be renters. But the modelling was for variable rate interest rates, which is about 65% of outstanding mortgage debt. And I was interested to see the Reserve Bank's modelling suggested that even if the Reserve Bank cash rate got to 3.6%, and they didn't suggest that was going to happen, but even if it did get to that, overall, most borrowers are likely to be well placed to adjust their finances, were their words, and only a small share would be vulnerable to falling into arrears. I guess that's because we've stashed a lot of cash and we're way ahead in our mortgage repayments, Andrew.
And we've had a lot of discussion. It becomes tiresome for the clickbaiters who deliberately look at those doom and gloom scenarios of the debt bomb, etc. Whatever happened to the debt bomb, Michael? But anyway, look, I think the point we've seen clearly is not only that Australians are absorbing higher interest rates, they're actually getting on with business in terms of purchasing property. It's all about the economy, stupid. So if I could use that analogy, we've got a very strong economy, record low unemployment rates, wages are rising. People, as you suggested, still have plenty of money in the bank through those COVID savings. I think what we're seeing, particularly in terms of the outcomes recently in our auction markets, our weekend auction markets, is that consumers are getting on with business, Michael. And our retail sales numbers are still soaring to record levels. I mean, they've leveled off a little bit over recent months, but they're still at record levels. That's the whole point. If our incomes are supporting our expenditure, then everything's fine. And as far as, where interest rates are going to land, we're now getting a number of, I guess you'd say, perhaps credible commentators at the Commonwealth Bank are suggesting just one more interest rate increase. And that would just bring us to perhaps under 3% as our peak. As we can clearly see in terms of what's happening with consumers, they're continuing to spend and they're also continuing to buy property, Mike. It's all about the economy. And as long as our economy is strong, particularly our labour market, I think Australians will be able to manage higher interest rates as they've done quite adequately to this point in time.
Sure. Well, the end result is that there are very few mortgage defaults. The
Yes.
banks are in a good position and most Australians have prepaid their mortgages because they
Yes.
didn't actually reduce their payments over the last couple of years when interest rates fell. So no scare about the debt bomb. But you mentioned a couple of times our auction markets,
Yes.
and we're into the springtime now where auction markets usually are solid. The weekend once again produced reasonable results, didn't it?
Well, I think they're quite encouraging results, Michael. We're certainly seeing an upward trend in the Sydney market. The Sydney market has really bounced back hard over the last month. Not bounced back, it certainly eased during winter, no surprise. Sydney was the strongest performing housing market through the boom times of last year. And of course, it was the first market to move into the negative territory in terms of prices growth. And that was more about affordability earlier this year because prices had risen so high that it was pushing buyers out of the market. Of course, along came interest rates, which just added to that not just affordability issues, but also to, as it always does in the short term, to confidence. Now, certainly the Sydney market has performed very encouragingly through spring so far. We're halfway through the spring selling season, Michael. Certainly on trends, we're heading towards a 70% clearance rate in Sydney. And I think that many a month or two ago would have thought that that would be just out of the question. And of course, once we get to 70%, I think we're moving beyond the sort of neutral zone of buyer and seller engagement. And we could start to see even some prices growth if that momentum continues through to the end of the year. So Sydney market has certainly surprised many in its upside. Didn't surprise me, of course, but that's another story. But it's a very positive signal that buyers and sellers are getting on with the business as they typically do during spring. Melbourne was down a little bit at the weekend, Michael. It had slightly fewer auction numbers. But when we speak about Melbourne, of course, next weekend is the super duper Saturday of auctions, the pre-Melbourne Cup long weekend holiday extravaganza of auction numbers we'll see next weekend. So we'll get a big number of auctions. So that'll be a very solid test for the Melbourne market, which has certainly been resilient, tracking in the mid-60s for some time now. So it will need to absorb over 1,000 auctions next weekend in that Super Saturday. Can you believe we're nearly at Melbourne Cup Day, Michael?
Amazing. And then there's, of course, going to be on Melbourne Cup Day, the Reserve Bank coming out with their interest rate announcement.
Which may be the last one in the cycle, according to some. But in the interim, we will get the inflation data. And that's the big unknown, is where inflation will land and whether they look at the September quarter or the September monthly data. Brisbane market's tracked back. We're not getting a lot of reported sales coming through from Brisbane. It's sort of quietened down in terms of what agents are reporting, but the Brisbane market's now tracking around about its normal levels. And I think a lot of what's happening in Brisbane is that the interstate surge in migration is no longer pushing that market up by extraordinary levels as it did last year. Still happening, of course, but not at the same rate. Adelaide bounced back, continues to maintain around 80% clearance rates, and just a sign that the Canberra market is also moving out of its trough at the moment. Interesting times, Michael, and certainly once we move out of that, the fear factor that's sidelining buyers and sellers, when they do start to see these better clearance rates, we'll then start to perhaps get the motivation that the market has bottomed out, and those that have been waiting, they just might have missed the boat, Michael.
Well, you're right. The cloud of consumer confidence is covering the sun, which is still a lot of good, strong fundamentals. Our economy's doing well. Unemployment is at very, very low levels. Immigration is coming in. Yes. There's no signs of an oversupply for our property markets. No. So let's hope that cloud of consumer confidence floats away, and we're going to have a good summer coming on. Look forward to our chat again next week, Andrew.
Thanks, Michael.